Should you dollar cost average, or should you lump sum, or even crash buy during market dips or corrections? This is the question that we are going to answer today, because there has been an ongoing debate around the Singapore personal finance community, and I'm here to address this debate. Who is right and who is wrong? I'm not here to tell you based on research paper and whatnot. I'm going to touch on the more personal note, and that is on the psychological matter, because I'm going to tell you what have I done with my own money so that I can share this personal experience with all of you, and then you can see whether it relates to you. Now, you see, the truth is that I have done both dollar cost average DCA plus lump sum very recently, so I can really speak from experience. So if you want the too long didn't read version, lump sum is going to win statistically most of the time. But that is not the full story. And crash buying sounds totally logical, but it almost never works. It is not about the math or the calculation. That is okay. But it's about your brain, how it works. And we're going to explore more in this video. And if you're new here, my name is Chris, an ex-chartered accountant turned personal finance YouTuber, and I run the Telegram group of close to 23,000 members who can join us for free discussions right here. Now let's start with dollar cost average, because that is how most of us invest or hear about how other people start investing, right? Every month we draw a salary, we take out a fixed portion of that salary or income, and we place this fixed amount of investment into a stock, an ETF, or an asset that we believe will far give us superior returns in the long term. So how it works in the perfect scenario is that you have an automated transfer from your bank account to your brokerage account being transferred automatically, and then the brokerage account will do the automatic execution by placing the buy trade at a specific frequency and a fixed amount. So you don't really have to touch it, you just have to set it up one time, and every month or every week or every 2 weeks or even every quarter, we will do the buy trade for you without you interfering. And this whole execution is known as the RSP, Regular Savings Plan, and it's what I have done consistently over the past few years. The mindset behind this is that I don't really check the price before it executes. Okay, I so don't care whether the market news is good or bad. I just need to do what I can control, which is placing a fixed amount of deposit to the brokerage account and make sure I have sustainable income to fund this RSP, be it every week or every month. So here is the realistic scenario after DCA, because if you bought on the market dip, you would be happy, right? Because you buy it at the low point. But if you bought it at the high point and then you drop thereafter, then you are confident that the next frequency, the next week or next month, you can buy in at lower prices. So you almost never feel stress or the emotional baggage behind it. Likewise, if the market rallies after you buy, you also won't feel FOMO because you already have skin in the game. So DCA and RSP kind of stick out the emotion behind all this emotional buying. Now, we all know the eighth wonder of the world, which is compounding. And this compounding actually works in the longer term. So in order to stay within the compounding zone, you need to keep invested and for the long term. And DCA helps you because you can consistently execute this action over a long period of time. And with DCA and RSP, you are able to sleep well because you're not so emotional. You can hold your investments for longer, and that's where the compounding effect starts to accumulate. And it definitely doesn't come from going in and out of the market frequently just to catch the high and the low. So if you ask me, what's the best way to automate this whole strategy? I would say is to do it via your brokerage platform so that you don't have to place manual trades every month. Just set it up one time and forget about it. Which brings me to share about the regular savings plan feature by Moomoo SG. Moomoo SG is a MAS regulated trading platform that offers low-cost trading fees and access to global markets like US, SG, HK, and more. And in particular, lifetime zero commission trading of US stocks and ETFs. And here's how to set up the RSP in 5 simple steps. Step 1, use my exclusive link here or scan the QR code to download the Moomoo SG app and sign up for an account using SingPass. Step 2, go to Markets, then US, then RSP, and create plan. Step 3, select paying account to bank account. So Moomoo can perform direct debit authorization from your bank account, and you don't have to transfer funds manually, which is less manual work. Step 4, enter the stock symbol, investment amount, and select your frequency. For example, ticker VOO 500 Singapore dollars every month on the 15th day. And you can start from as low as 10 Singapore dollars or 5 US dollars if you use the margin account. Final step, enter your trading password and click confirm, then you are set. Moomoo executes the trade automatically every month without having you to touch anything. If you're unsure whether your regular investment plan can be profitable, Moomoo's RSP calculator can help you easily estimate it. By backtesting different regular investment plans, you can quickly calculate how much return you could potentially earn under different investment returns and time horizons. This is exactly the remove the decision and removing the anxiety strategy that I discussed. The automation is the whole point, and Moomoo also has welcome rewards for new users, which I'll share more later. Now let's talk about lump sum, because earlier this year I shared about my SRS investment strategy where I had a lump sum transaction coming in, and I intend to invest multiple lump sums after I have received the inflow. And the timing of this fund is so lucky, right? I received it in February and I deployed multiple lump sums throughout the month of February. And immediately, on the last day of February, there is a geopolitical tension that escalated between US, Israel, and Iran. So oil prices spiked rapidly and my portfolio suffered a very negative unrealized loss. I want to be very honest, the feeling is not great, especially when you did lump sum just before the crisis happened. And even though I've been through several market corrections and crashes, the feeling is still not good, even though I've been suffering all these years. And watching a lump sum go immediately negative after you invest is not fun. But the truth is, I did nothing after that, because doing nothing may be the best move rather than realizing your losses on paper. So if you look at it, the key reasons between lump sum and DCA is really on the emotional load. Like, I feel really bad after doing a lump sum and then seeing it go negative. But DCA is quite different, right? So if I do multiple DCA, I can see that the next frequency, I can invest at a better pricing. But with lump sum, there is this emotional load going on. So that's the main psychological difference. Lump sum can be very susceptible to market timing and luck, right? Whereas DCA is more systematic, more automatic, and it's more like a robot kind of investment method. So both strategies of investment actually do work. It's just that it's suitable for different groups of people. But yes, investment strategy is all about supporting data. So here is some data that I have found. So I used the AI agent called Claude and vibe coded this with these assumptions. For the capital of $12,000 per year, I'm going to assume that DCA is $1,000 per month. Then lump sum is the full $12,000 deployed on 1st January every year. I'm also going to add in a third strategy, which is crash buying. And the thesis is that for a 100% cash allocation, every time there's a 10% crash, I'll deploy 10% cash. And then 15% crash, 15% cash deployed, all the way until 30% crash, where I'll be fully deployed of my cash. And at the same time, I'm going to assume that idle cash earn 2.5% per annum interest on the side. So it's the same index of S&P 500 and the same period. And you can see from the results that over the last 30 years, lump sum would actually win out these two buying strategies. And this is consistent with Vanguard's research across US, UK, and Australian markets, which found lump sum outperforms DCA in about 68% of the rolling 12-month period by roughly 2.3% annualized. And the reason why is very simple, because markets go up most of the time, like 73% of the time the market is going up. So by staying out of the market, you are not actually on the rising boat. And every day that your cash is uninvested, the probability is against you. So if lump sum statistically perform better, then how about DCA? If you look at DCA, it actually tracks quite closely, just slightly behind lump sum. And especially if you factor in the psychological and emotional load compared to lump sum versus DCA, actually DCA is not a bad strategy at all. And the more likely fact is that DCA investors are probably able to hold on to their investments and stay invested longer compared to lump sum investors who may not have the emotional capability of holding on to their investments during market crisis. Because I can assure you, a lot of people will panic sell during the crash, during the correction, and during market turbulent times. This is a fact. Now, I also want to talk about crash buying, but this time from a psychological perspective. And let's go back to our chart. You can see that the lump sum and DCA has a very big gap compared to the crash buying results. So the theory behind crash buying is that you wait for a 10% crash, which is quite significant. Then you start to deploy your 10% cash. Then for every 5% thereafter, you deploy a big chunk of your cash. It sounds very logical, very rational, and in fact, the math is superior, right? It sounds really good to be true. But here's the real problem. I just want you to dial back to 1 year ago, during April 2025, when the Liberation Day crash started by the Trump tariffs. How many people actually went in during that crash? Because that crash was definitely more than 10%, in fact close to 20% on the S&P 500. How many people around you actually managed to execute the crash buying strategy? And the crash was not like a few days, it was a few months, starting from February all the way to April. So there were ample time to execute the crash buying strategy. But you think about those who have showed up and did crash buying. How many people really executed it? So I'm sure most of you already have an answer. And the reason why most people don't execute during a crash is because when you are inside the crash zone, all the market news will tell you that this is the worst period and things will go worse and worse, and that investors will lose so much generation of income and gains that they can no longer require, because news sell on fear. Right? You will keep hearing news that tell you not to invest, the crash is not yet here, this is not the worst. And everyone will tell you to stay on the sidelines, wait for more clarity, wait for everything to settle, then you start investing, correct? But the truth is that when you have more clarity, the markets will have rallied back up in a V-shaped recovery. And this is exactly what happened last year. Because 3 months later, the April 2025 Liberation Day crash recovered fully after the 3 months. And if you remember COVID 2020, it recovered in 4 months. So all these are very fast recoveries. So when you want to execute a crash buying strategy, the time frame is not in months, but in weeks or even days. So as of the time of recording, the S&P 500 is about 7 to 8% off its all-time highs in January 2025. And I know that it's a very uncomfortable period right now for everyone. And I know that it is very close to the crash buying zone really of 10%. But if you think about it, if we really crash the 10% zone, are you going to start your crash buying strategy, or are you going to wait for further clarity? Because if you look at all the people around you, when the crash really comes, do you see them say, perfect, I'm going to start deploying my cash and start the crash buying? Or do you see more, the crash is not ended yet, I'm going to wait until the bottom, then I start buying? So here's my point based on my experience, my own money, and past 30 years data. Lump sum is definitely the mathematical superior strategy based on past data. But remember, past performance is not a guarantee of future results. And this is exactly for lump sum. If you are okay with just dumping one whole lump sum and you don't have the emotional load, you can take the downs after investing a large sum of money, go for lump sum. But if you want to manage your emotions better, you don't want to have so much load on your psychological and emotional factors, then go for DCA. That allows you to hold consistently for long term so that it can keep you invested throughout the volatility. Then my pick is to always do dollar cost average. And here is why you should use Moomoo's RSP, especially if you are new to Moomoo as a new user. For their welcome rewards, you can get up to $1,864 when you fulfill the funding, trade, and hold requirements based on the terms and conditions, which also includes a KOL bonus of 20 to 100 Singapore dollars of NVDA fractional shares. For cost-wise, there's lifetime zero commission for US stocks, which helps you manage your RSP costs. So use my exclusive link or scan the QR code to get started with Moomoo today. Now, I want to end it off with crash buying works in theory, but probably never in practice. Not because the logic is wrong, the math is correct, the logic is correct, it's just that human psychology will be very different when you are in emotional load and fear, because most people will hesitate, especially during market turbulent times like this. So there's no best single investment strategy, it is the one that you stick to. If you're very good in crash buying, you can ignore all the emotional load and whatever, then yes, go for crash buying. If you're good with lump sum, go with lump sum. If you don't want to do anything and just want to automate, go for DCA. There's no one single best out there. So which kind of investor are you? Are you the lump sum investor, the DCA investor, or the crash buyer investor? Comment down below and let me know what you think. And if you want to look at my own personal investment strategy for 2026, then you can refer to my previous video right here.